So here's my big question. Are we looking at a new investment strategy that must be built on pro-growth tax cuts? Is it time, therefore, to sell the bonds, buy the stocks, and incidentally, hold on to the dollar? Let's bring in our investment all-stars. We have Jim LaCamp of Macroportfolio Advisers, Bob Froehlich of the Hartford, Lee Munson, Portfolio Asset Management. I want to go to Jim LaCamp right away because I see a lot of hand-wringing about rising Treasury rates. It's not all that much. But I'm here to argue that rising Treasury rates are actually very bullish because tax cuts will stimulate the economy. It's the real interest rate, the economic growth component of the Treasury bond that is rising. And to me, that says buy stocks for growth. We're going to get this huge across-the-board tax cut. How do you react?
Well, should we buy stocks? Should we sell bonds and buy stocks? That's two different questions. It's not just one question. And Larry, when you look at a bond market rout like we've seen over the last few days, you have to ask, why is the bond market getting killed? Is it getting killed because of growth expectations, or is it getting killed because we're worried about quantitative easing not working and the bond market rioting? In other words, is it getting killed because there's not enough spending cuts here? And we didn't see much of a stock market rally over the last few days.
Well, I
do think it's time.
But what's the new thing? See, here's where you're right. Stocks are on hold in the last day or two because they're worried about the House and Nancy Pelosi. That's what I really think. If you look at the tips, the inflation-protected Treasury securities, that's the real interest rate. They've gone up. 3/4 of the rise in Treasury yields have come from real interest rates, which tells me, yeah, down the road the Fed may be a problem, Jim. But right now everybody's looking at this growth-oriented strategy from tax cuts, which I think will boom stocks even while Treasury bonds fall in price.
Well, I do think stocks are more attractive than treasuries here. We have a pretty nice playing field for stocks. Interest rates are still pretty low, and now bonds are becoming less attractive as an alternative. However, this playing field that is pretty attractive for stocks is surrounded by all these volcanoes that are still bubbling. We have the Greek debt crisis that's showing higher interest rates over there. We have the bond crisis here. We have potential for Chinese tightening. So investors, yes, be in stocks, but be very careful and be nimble here.
All right, Lee Munson, the issue is joined. It's on the table. I want you to weigh in, and Mr. Froehlich, too. Lee, you first, please.
Well, I would disagree with Jim respectfully that, stocks and bonds are competing investments. So when you ask that question, it's one and the same. You're either going to go for the safety of bonds, which I think is a nightmare right now. I do think you have to sell your bonds, and I do think that you have to buy the stocks. The only thing that I would put out there is I'd stay in the United States because we have Chinese political problems that could lead to a disaster in that country where, hey, listen, Larry, I know that you're a dollar
Thank
lover.
God we don't
you're
have
not
any political problems over here.
I listen, but I think that we're going to have a strong dollar, and I know Larry's going to love that.
I do love that. And the same reason,
I think you're right.
The same reason holds. Lower tax rates, which raise real economic growth, is bullish for the dollar, which is a great reason to back up your assertion that people should stay in the U.S. In fact, I dare say foreigners are going to come into the U.S. if this tax cut package goes through.
And I agree with you, and I think people need to understand that it is a single question, stocks or bonds. You can have a mix, but you need to make a decisive decision right here, right now. I think you need to be more stock heavy. I think you need to be more U.S. centric than you ever have been, and that's it. Period. The only things I like
it's not a single
I like the banks where you get the money, and I like the energy.
In stocks or bonds. There's commodities. We still have gold, precious metals. There's all sorts of investment alternatives investors have these days. They certainly don't have to say, I'm all in stocks or I'm all in bonds.
I understand.
Look, the commodity cycles usually last 20 years. There's other choices here.
Well, there's another issue,
you can have 5 or 10% in gold. All my
Lee.
clients have 5 or 10%
I've got to get Mr. Froehlich. Dr. Bob's been waiting very patiently. Please weigh in stocks versus bonds off of the back of the tax cuts, Bob. Yeah. And if you care to, commodities also. There are two kinds of commodities. There's industrials, and then there's precious metals. So go ahead, Mr. Froehlich.
Larry, this is a no-brainer if ever there was one. You have to sell the bonds, and you have to do it right now. The last couple of weeks was a wake-up call. Look, here's the deal. The bond market will be down 40% in the next 6 months. You want to make money in this market, you better be in the stock market, because when we get to the end of 2011, the Dow Jones Industrial Average will be at its all-time high. It'll be above 14,000. This rally is for real. The tax cuts are going to happen. But I also wouldn't mind in this environment to have a basket of commodities, because I do believe the growth of the emerging markets is going to continue. These countries, these emerging market countries, Larry, they all have the exact same problem. They have to create a middle class to create us. If they do that, they're going to use an awful lot of commodities. So I want to be out of the bond market. I want to be in our stock market in a big way. And then I want to have some assets that are non-correlated to stocks and bonds. So I love that commodity play, and it's a way to play the emerging markets.
Jim LaCamp, what happens
you like China, though, Bob? I thought you liked China every day. You think that people should still step into that with its political risk right now?
Absolutely, positively, I do, because the biggest risk in China that they have is not political. It's the fact that they have to create a middle class. They have the haves and the have-nots. Once you open capitalism, which they have, there is no turning back. There is no way they can pull that back in. Because of the technology, people are seeing the way the rest of the world is living. They want products like we have, products like the people in Europe.
I'm glad you're so confident in that regime.
Yeah,
China's got political problems with 7 to 10% growth. We've got political problems with 2% growth. Which are you going to rather have? Which country's printing money? Which country isn't printing money? Look, China's got problems, but they've got a much better growth rate and a surplus from which to absorb those problems.
Yeah, but Lee Munson, if the U.S. growth rate goes to 4%, okay? You may not agree with that, but I just want to put that on the table because I think these tax cuts will be very powerful. Then long-term treasuries go up another 100 basis points, frankly. They'll go from 3.25% to 4% or maybe a little higher. Doesn't that weigh down gold and silver? It might benefit industrial commodities. I agree with Dr. Bob because that's good for the economy. But what about those precious metals? Maybe we should tack on better growth from lower taxes, higher dollar, get out of gold. Does that trade appeal to you?
No, it doesn't. I'll tell you why. If you do your homework, which is hard to do, and you actually do your due diligence over the last 30 years, you're going to find that what's called an inverse correlation, when the dollar goes up, that gold goes down and vice versa, that only occurs 50% of the time. The other 50% of the time, gold and the dollar match each other going up and going down. So I would be hesitant. Listen, Jim LaCamp has a good point. I do think people should own some gold, maybe 5 or 10% of their portfolio, but I also think that these people who are so used to this inverse relationship need to look back at history, look at, run an Excel spreadsheet, do some homework. The dollar and the gold can go up at the same time. We've got a worthless euro, and the Germans are pounding the table on that. And remember, gold is the only thing, and this is in Jim LaCamp's favor, it's the only commodity that is priced in every single currency.
But Dr. Bob, I'll give you the last word. We have not talked about QE2 and the Fed, which could make higher gold come true if they reinflate everything. But I just want to ask you, in terms of today's news and yesterday's news, the bank stocks, Dr. Bob, are hot as a pistol. Can you just give me a lightning fast take on why these bank stocks are hot, and will it last?
I think they're hot because I think what we're going to have is we're going to continue to have a yield curve that's steep, so they're going to be able to make money. Finally, they're going to start lending again. But more importantly, as business confidence comes back, Larry, I think we're going to see an uptick in mergers and acquisitions in 2011. That is extremely bullish for financial services companies.
And better growth from tax cuts got to be good for banks like everything else.
Awesome.
Jim LaCamp, thank you very much. Lee Munson and Bob Froehlich.